Hey, good morning, everyone, and welcome back to Derek Invests or Derek's Mind. I don't know which. It doesn't really matter. It's me, Derek Miller, your host. Your hostess with the mostest. So today, what I want to talk about are options and futures. So what did we talk about yesterday? We talked about the likelihood of the fact that AI would be leading a stock market bubble. And we looked at earnings, like the PE ratio, right? We looked at PE ratios. We looked at other fundamentals, company specific. We also looked at a macro picture. And in the macro picture, one of the things that I discussed with you was speculation. Speculation is a large driver of any bubble. And any bubble, when we use the term bubble, you can also reflect on the fact that bubbles burst. So bubbles burst and they lead to large stock market declines. And what we want to talk about today is one of the things that is speculation in today's market that wasn't as widely used up until a few years ago. And it's had just the trend has been growing, right? So yesterday we discussed the stock markets, the indexes. We touched on crypto there at the very end of that conversation, and our basis was AI, because that right now appears to be the driving force for technology, and technology is obviously the strongest index. One of the things we mentioned was speculation, and something that limits speculation is regulation. Isn't that funny? Speculation is limited by regulation, meaning there are margin requirements that have to be met when you are trading stocks. And those margin requirements are effectively a 2-to-1. So you can trade 2 times the money you have within your account. So let's talk about the uses of options and futures and how they affect that conversation. Is it wise to use options and futures? Is it not wise? Why do people so widely? Were they so individual investors, retail? So first, let's talk about the growth of options and futures. The growth is 500%. So from 2013 to 2023, the growth of the use of options and futures contracts globally is 500%. So options and futures contracts have really been adopted. Okay, so you can view this in any way you like. There's 2 ways to take a look. There's 2 ways to look at options and futures. You can look at it through the eye of this is used for speculation. This is something that you're using to avoid that margin that you have to have when you're trading a stock. So you want to add more leverage, and we'll discuss that. Or it could be a sophistication indicator. It could be an indicator that retail, that individual investors are becoming more sophisticated. Why? Well, that takes us to the same conversation, the same point. And that point is leverage. So let's talk about how leverage works real quickly. And then we'll talk about the difference in leverage between stocks and options and futures, and why that can be so beneficial and why it can also be so harmful. So the leverage that you can use in the stock market is 2-to-1, right? So twice the amount of money you have is able to be traded. In options and futures, it varies from a 10-to-1 to 20-to-1 scenario, meaning that the margin requirement's 5 to 10% traditionally, okay? Don't hold me to that with a gun, but traditionally it's 5 to 10%, which means that you can trade 20 times 10 to 20 times the amount of money within your account. How can that be beneficial to you as a retail investor, as your average investor? And how can that be detrimental to you? Very, very simply. Okay. So I'm saving you. Okay, if you have 10,000, trade 100,000. How much do you have to lose before you're at zero? 10%. A 10% loss will eliminate your $10,000. On the flip side, a 10% gain will make you $10,000. Options. The structure is significantly different because you have different attributes at play. If you have not watched it, you need to go watch my series on what are options and how do they work. It's not as long as you think. It's pretty quick. It's a 20-minute conversation where we go over expiration, we go over time decay, we go over strike price, in the money and out of the money. I'm not going to get into all the technicals in options, but the leverage is very similar to futures, okay? But there are some more factors inside of options if you're going to trade them. And I can even redo a little video on options, but I do have that available to you if you go look at the options video that I have. So let's talk about the futures market and the options market as a speculative market. So why is it speculative? Well, very simply, if you only have a small account, you can make immense gains. But you have to be right, because as we just discussed, when you're working with that much leverage, now imagine that it's 20 to 1. Okay. What can you afford to lose? Well, if it's 20 to 1 and you have $10,000, you're trading $200,000, you can afford a 5% loss before your money's gone. Contrarily, what does a 5% gain do for you? It makes you $10,000. So you can see the advantage there, right? And options working very similarly. Different structure, as I just mentioned, but as far as leverage goes, very similar. So now, how is it beneficial if you are a retail investor, but you're not a speculator? That's not your goal. You're not looking to speculate. You're not looking to add all this leverage to your account. Not in that way. What you're looking to do is reduce risk. Now, this is why institutions use futures and options and why market makers use futures and options so prevalently, because you can reduce risk tremendously. How can you do that? Well, just imagine if you have, $100,000 account and you're trading $90,000 on the S&P 500 and you want to cover that. So cover means you see a lot of risk in the market. You say, you know what? I heard the conversation, as Derek said yesterday, and we kind of came to the conclusion that it doesn't appear that we're in bubble territory. At least that's my view. My view is that it doesn't appear that we're in bubble territory. Remember, I'm someone else. And I believe Alex, not Derek, believe that we're not in bubble territory. I just provided the information yesterday. So I want to cover my assets. Cover meaning I want to eliminate the risk of this portfolio, or I think it's a bit risky. I would eliminate half. So what you want to do is you want to eliminate, say, $45,000 of equity exposure. So half of your overall position, you want to cover. You want to eliminate that equity exposure. You believe something's coming. You believe it's coming in the next month, next 2 weeks, whatever your time frame is. So you go in and you buy some futures contracts, right? You go buy futures contracts. You have it's a 10% margin requirement, so 10 to 1. So you take $4,500 and you are able to cover 45,000. Half your account is now not exposed to a rising market if it falls. You will actually make money if the market falls. You are short futures contracts on the S&P costing you $4,500, and it covers $45,000 in equity exposure, which means you now don't have $90,000 invested. You have $94,500, which leaves you $5,500 in cash. So it only cost you $4,500 to protect yourself or protect your account at a $45,000 level. Now, if you're right and we go through, let's assume you believe it's a market correction and it falls 10%, what happens? Anybody? What happens if it falls 50%? You can see what I'm getting at. It's easier to cover your account. It's inexpensive to avoid falling markets. So to limit risk at a low cost. options are much the same. Okay, so they're used much in the same manner the futures are. So you can do two things with these two investment vehicles, these two derivative vehicles. You can limit risk inexpensively, or you can speculate on what's coming for a greater return, realizing that you have to be right now, because with the leverage on these and the mechanics within these particular vehicles, you can make money quickly, but you can lose money just as quick. Okay. So what I wanted to mention today was I have down there, as you can see, brought to you by Tradier. I'm not connected with them that I don't want to be or that I couldn't be, but I am not at the moment. The reason I saw that on their website that they are offering, and here I'll actually throw this up for you. They are offering an unbelievable price on their options contract. So it's like up to 1,000 options contracts. You're able to trade for $10. I believe it's your initial month. It's $10 for up to 1,000 contracts. But I mean, it's worth a shot from what I saw. I looked at Tasty Trades. I work off of TradingView, as most of you know. It's always up when I'm talking about charts I'm scanning, and they're directly connected to TradingView. So I happened across Tradier, and so they're offering up to 1,000 contracts for $10 in your initial month. So the cheapest I could find for those 1,000 contracts was $650. And then the most expensive that I found was through Tasty Trades, and that was $1,100. So it really makes no difference where you go. If you're working through TradingView and you want to give this platform a try, I would suggest it. It can save you anywhere from $640 to $1,090 on a lot of contracts in your first month. So anyway, I thought that was worth mentioning to everybody because all of you options and futures traders know the cost. And they're not, I didn't see futures available. It looks like they're going to have futures trading available here in a few weeks. So look out for that. Right now it's options and stock. So if you're looking to cover some positions, if you're looking to speculate a little bit, go ahead and head over there. Check it out. There it is right there. You can click on the QR code. You can it'll take you directly to their site, and you can see for yourself. I found it very easily, and I just simply click through TradingView. So if you use TradingView, if you don't, maybe go give them a check. Go give them a look. Again, I am not directly connected with Tradier. I am simply bringing it up because I found an inexpensive cost on the subject today. Not that I don't want to be in business with them or that there's no future prospects. I have no idea, but at this time, I'm just mentioning it because it is inexpensive. So go check them out, everybody. I will pull that down. This isn't meant to be a commercial. It's just meant to help you out. Okay, so what did we learn today? We learned that the options and futures market has grown by 500%. We have learned that can mean two things. It can mean, one, we are in an extremely speculative market and getting more speculative, which I would give probably a smaller probability to than we are getting in a much more sophisticated market on the retail side, on the average investor side. And folks are starting to catch on that you can use options and futures to mitigate risk. So when you see market risk, you can mitigate it. The effect of the underlying securities, which I did not cover, is it has a dramatic effect on the underlying securities because people look to options and futures for a few reasons. The first being on that first layer of the market is market makers, and they're looking for arbitrage. They are looking for inefficiencies in the underlying security and the options and futures market to draw them closer to a 0% risk, which is the goal of market makers. And that also is why a lot of you folks think that your options always get wiped out. Why do my options always get wiped out? That is simply because market makers are looking to hedge their hedges. And that means that anything that they need, they're creating markets, right? So there's a buy side and a sell side. When they buy something or sell something, I won't get into the Greeks. We don't need to go that far right now. But when they buy or sell something, they need to cover that position. In doing so, if they're looking for a 0% risk, that should create a magnet at whatever that price level is, whatever that spot level is. It should there's a magnet there that should pull price there, right? So you can see why options, if it's being pulled to a price and your market makers, the creators of the market, the creators of the transactions that enable markets to transact, are putting this is their mark, right? This is where they're at, and they're creating zero, and they needed to do this and this. There's naturally a magnet right here, and that's why I always talk about these large magnets in markets, and that you need to be aware of them. Because that is where price pulls, especially if you are trading futures and options. If you are not aware of where those magnets are, I suggest that you start learning about where they are. So that is why that happens. So we can see that there are speculators in markets looking to make a lot of money. So that's one reason. And then we said that that's probably less probable. The more probable reason is the inexpensive hedging in the futures and options. But if you are getting into futures and options, I would suggest, if you have not done so yet, that you need to explore and learn how the three layers of the market work. I call them three layers because it's very simple. You have your retail, your average investor, then you have your large institutions, hedge funds, brokers, these people, and then you have your market makers. They effectively create the ability to transact within the market. With options and futures up 500%, and these magnets existing, what does that do to the underlying price of the security? Well, you can imagine if spot price, so the price where that magnet sits, is below the security being traded. So let's say the S&P 500 is being traded. We're going to use fake numbers because I don't want anyone attaching this to the S&P 500. It's at 1,000, and market makers, and they would never be this far away. But let's just, for the sake of this conversation, they are at 900, right? So they have to travel. If you're in a car, you have to travel 100 feet, which is 10% from where you are. You can, if you're looking at this and you see it, and there's all this volume here, and you can see that there's a lot of action over here, and it's 2 months away, you could say, well, in 2 months, it looks like the spot price, the value of the S&P 500 should go to 900 from 1,000. From 1,900. So would this be a high risk area? In fact, it would be a high risk area. So if this is a high risk area, you can do one of two things. If you're a speculator, you're going to short futures or options down to that spot price of 900, and you're going to try to make a gang of money. However, if you're invested in the S&P and you're up here to 1,000, and your interest isn't to sell everything and then go short to make a bunch of money, and there's a lot of reasons you do that. For one, tax implications, right? If you're a long-term investor, even if you're a swing trader, you do want to limit the amount of trading you're doing within a 12-month period, especially if you're in a high tax bracket. Because if you're a short-term trading at all times, you're paying like 50% in taxes. Whereas if you go long-term is anything over 12 months, that means you're going to the long-term cap gains rate, which is between 15 and 20%. So you can see the variance there of the 30% in tax, right? It's 30 to 35% variance in taxes. So you may not want to sell your stuff. Maybe you've owned it for 10 years. Maybe you got it from your parents. I don't know. But what you want to do is just protect your assets. Then you'll go into the futures and options market to cover these assets up here because of the spot price. Then obviously it works in reverse. If you're looking at futures and option market 2 months from now, there's large volume everywhere. You're sitting here at 1,000, and then here we are at 1,100. If you are looking to accelerate your returns because you own all these positions, you don't want to. You're not gonna sell and buy triple leverage ETFs, right? You're gonna hold these positions, and you may buy futures and options contracts to get you to 1,100. And then if you're a speculator and you own nothing, again, you're going in and out on a daily basis, on a 5-minute basis, on a 30-minute basis. You're going to buy them to make a bunch of money. So it's one indicator that you should be looking for if, in fact, you're using options and futures. If you don't know what a market maker is, if you don't know what Greeks are, I suggest that you get to know them, because that has a dramatic influence on the markets that you're working within. So I'll give a shout out to a good friend of mine on Twitter that runs Vol Signals, VOL Signals, and he is someone that discusses the Greeks, has up-to-date information, and runs courses based on the Greeks, on where these large magnets in spot prices are, and he offers you information on whales. So on people that are placing huge trades, where they're placing them and how they work. Vol Signals is a great guy, and he's very, very, very in tune with what's going on, and also very helpful and a pleasure to listen to. So check him out if you're on Twitter at all, at Vol VOL Signals. Here, let me go ahead and give you. There we go. So at Vol Signals, this is on Twitter, everybody. So if you have a Twitter account and you trade options or futures, you really want to follow at Vol Signals. Amazing research and information, and a good guy. So in any case, he's helped me a lot. I've taken the course. I can tell you his VIP mentorship course is phenomenal. It's what introduced me to market makers, the Greeks, how spot works, how market makers work in general, and then how that affects the market. So in any case, check them out. I think we covered everything for today. So as far as our discussion on bubbles, could you take the increase in options and futures use over the last decade up by over 500%? And there's a very specific region that has really got involved, and that's India. If you could take that as, okay, well, that's speculation. If you take that as speculation, then yes, that would mean we are in a more speculative market today than we ever have been. If you take it as the same way I'm taking it, retail investors are getting more sophisticated because they have the ability to learn more thanks to what we're doing right now, social media and the internet. Then no, in fact, they're getting smarter, which means volatility in the market should be reduced, which we're going to talk a bit about that tomorrow. Why is volatility so low in markets nowadays versus before? And I think we just touched on one piece of that. So if you, again, as I always close, if you are having any mental health issues, if you are upset today, if you are sad today, if you just don't feel good, listen, put a smile on your face, okay? Everything's going to be all right. It will be. Smile until it's real. If you have to fake it a little bit, fake it. But smile and do something you enjoy. Get out in the sun. Do not lay in the house all day. Do not find yourself just running in your head. Do things that are productive, that you enjoy. All right? This is something I enjoy, and it keeps me going every single day. So I want to thank you for joining me. And listen, as always, every day above ground is a good day. Thank you so much for tuning in. And I look forward to talking with you tomorrow about volatility.